Welcome back, ladies and gentlemen. Thank you all for joining me today. We have a very exciting video for you today. Now, we're going to be taking a look at a quarterly review. If you couldn't tell from the title already, we're going to be looking at Dropbox. Ticker symbol is DBX. Now, I really like this company. I like the management team. I like what they've done with the products. I love everything about it. Obviously, there's some risks involved in things when you're investing in individual companies. But with that being said, we're just going to take a look at their quarterly results today. And if you want to take a look deeper into the video that I've done before this, make sure to look at the link down in the description. That'll tell you, and you'll be able to see like what my thoughts were when I was getting into this and what I was really looking at, what my estimations are and all of that. Obviously, we'll probably have to do an estimation video kind of update in the future. But with that being said, let's take a look at the quarterly review and let's dive right into this. Now, first things first, going to be using the girlfriend's iPad as always because I don't remember this information. And again, this is going to be the Q3 2022 overview. Now, first things first, taking a look at the earnings report. This is actually like the earnings results that they put out. The top line things and things that I wanted to kind of note was they said that third quarter revenue was $591 million, which is up 7.4% year over year. On a constant currency basis, that would be up at 9.7% year over year. So, you know, pretty decent growth, 7%, 9% if you're looking at constant currency, but 7% if that's what you're looking at for the Q3, which is awesome. Their ARR, or annual recurring revenue, was up $2.43 billion. That's up 9.6% year over year. On a constant currency basis, that's 10.2 year over year. So again, pretty good, decent results. I really do like that this company is a recurring revenue business. I really like that the fact that, you know, the way that they recognize this revenue, in some cases they'll get paid at the beginning of the year and then they'll, you know, kind of recognize it throughout the year as each month passes. Basically, you know, it's as they deliver the service each month, that's when they recognize the revenue. So that's kind of why you have that recurring revenue in the way that they take a look at it. And again, just to quickly note before I keep going into this, they did have some price increases over the last couple of months that we'll start seeing flowing into the revenues side of things as well as the earnings. So with that being said, let's keep going. So GAAP and non-GAAP operating income, $89.3 million and $186.7 million, up 15% and 16% year over year respectively. So you're going to see a lot of things that are GAAP and non-GAAP, especially on a company like this, because they try to take out some of the different items that go into GAAP earnings like SBC. And, you know, when you're looking at stock-based compensation, some people think that it's an actual expense. Some people don't think it's an actual expense. Whether or not you think it's a cash expense is obviously up to GAAP, but the fact that some people will include it in their calculations, others won't, that's kind of like a dividing point for a lot of people. Now, what they said was that we delivered another strong quarter amidst an increasingly challenged macroeconomic backdrop, is what Drew Houston stated. In particular, we're pleased with the results of our changes to our team's plans and excited about our progress innovating around new products and driving multi-product adoption, including the release of Capture to all Dropbox users and the introduction of rebranded Dropbox Sign. As we look towards 2023 and beyond, I'm proud of our team's execution towards our strategy while maintaining a healthy balance of growth and profitability. Now, what he's referring to with Dropbox Sign is HelloSign was an acquisition done by Dropbox, the company, and recently they rebranded HelloSign so that way it now says Dropbox Sign to kind of make everything mesh correctly and to make sure that it's not unclear, you know, the fact that HelloSign is or isn't owned by them. So that's something that's really important that I want you to note. Taking a look at the third quarter results, I'm not going to go through the ones that I already kind of touched on. Again, revenue is $591 million for Q3 2022. ARR is $2.431 billion. And then obviously going on, so paying users ended at 17.55 million as compared to 16.49 million for the same period last year. Average revenue per paying user, or ARPU, was 134.31 cents. So as compared to $133.79 for the same period last year. Not crazy growth on the ARPU side. And again, they kind of mentioned in the calls that a lot of that has to do with teams and the way that the seats are given on the different plans. So that's something that I wanted to note as well. As you know, that's part of it. And obviously you want your ARPU to go up because that's really where a lot of the money is made, is where, you know, you keep adding users and those adding of users actually generates more and more sales. GAAP gross margin was 81.4% as compared to 79.6% for the same period last year. Non-GAAP gross margin was 82.9% as compared to 81% for the same period last year. So you love seeing some margins go up. GAAP operating margins was 15.1% as compared to 14% for the same period last year. And again, non-GAAP was 31.6% as compared to 29.3% for the same period last year. So GAAP and non-GAAP both are having some growth in margins, which is awesome. Again, I mentioned net income earlier. Not going to really go too deep into it. You can see it here, 83.2 million versus 75.6 million. Non-GAAP is 153 million versus 147 million. Really, net cash provided by operating activities of $251 million as compared to $231 million the same period last year. Free cash flow, based on the way that they calculate free cash flow, was 245.2 million as compared to 221 million the same period last year. And so what they're trying to do, and I'll kind of go into this a little bit more later, but their goal is to get to $1 billion of cash flow in a single year. That's kind of their end goal. And right now, they're on track. They're not too far away from that. So to see them increase that free cash flow and continue to increase that free cash flow is awesome to see. GAAP diluted EPS is really 23 cents as compared to 19 cents for the same period last year. Non-GAAP EPS is 43 cents versus 37 cents last year. So not crazy growth by any means, but some nice solid growth over the year and year to year. It's really what you want to see. Cash equivalents, and short-term investments ended at $1.453 billion. So moving on, we're going to take a look at sort of some of the statements and things that they had, and some of the things that I wanted to point out, and kind of the things that I think may or may not be important to you, especially as you're looking at this, and things that I wanted to point out that I thought were pretty important. So taking a look at the really the net income statement, consolidated statements of operations. So the 3-month mark, again, $591 million on the revenue side versus $550 in 2021. If you look at the 9 months, we're up a little bit, but I wanted to see, you see on the right side, I have two numbers. So for the revenue side, that's a 7% increase. And then if you move down the sort of, the income statement that you see here, one of the things that I wanted to point out was the R&D. So look at the increase in spend in R&D versus the revenue that they have. So 227 million versus 187 million last year. And then obviously it's an increase of 21% in the R&D space. Sales and marketing did come down a tiny bit, and so did the G&A. Not really that surprising. And then obviously they still have to impair some of that real estate assets that they had. So again, not really that surprising. Again, they ended with a positive net income, which is awesome. They didn't have a positive net income in 2020. So they're starting to kind of turn this around. And part of that has to do with the fact that they had to impair their real estate. So I do love to see, though, that they're making some strides here, and I'm hoping that they can continue to grow this company forward and continue to, do all the things that they've been doing. One other thing that I wanted to mention, I mentioned it earlier, was the stock-based compensation. So that's what this graph is here. And again, it increased 19%. So not really too surprising, when you take a look at it. But I just wanted to really point that out because I think it's important to understand where is all that stock-based compensation going and what is it actually going to. And it looks like a lot of it's going towards the engineers that are working on these projects. So that is something that I do want to point out because it is very important that you understand, if stock-based compensation is being offered, where in the world is it going to? Moving on to the balance sheet. So popping up the balance sheet here again, as I mentioned earlier, you got quite a bit of cash and short-term investments as far as liquid items and really just total current assets all over, all together. Property and equipment net have come down just a tiny bit. Operating lease links have come down a tiny bit, and then their goodwill moved just a tiny bit. And that, when you're looking at a company like this, that goodwill, if I'm looking at assets and liabilities, I usually take goodwill out because it's really not that important. And it's kind of used to just kind of balance the assets versus liabilities. And it's not like a tangible asset by any means. It's kind of just an estimation. But taking a look at the liabilities side of things, so accounts payables up just a tiny bit, accrued and other current liabilities down just a tiny bit. The other thing I want to mention, deferred revenue. So that's kind of referring to when they have to deliver service, because they might receive it at the beginning of the year and they have to recognize it month over month or quarter over quarter. So total current liabilities not crazy up, and again, part of that has to do with deferred revenue. Operating lease liability has come down quite a bit, and that's part of the reason they're doing that remote work first. The convertible senior notes hasn't really moved all that much, just a tiny bit up. And then other than that, they don't really have any other debt or things that they owe. The convertible senior notes is kind of one of those things that you should be paying attention to because that can affect the shareholders later on. So it's something that I just wanted to point out because it hasn't really done any moving. And if they have the option, they can buy it back later on. But obviously, you're going to see what they're actually trying to do with their free cash flow right now. So again, going to the free cash flow reconciliation, this is all from their own reports. So for the quarter, $245 million, free cash flow margins, 40%. Nothing too crazy. Again, it's going to kind of depend on what they're spending CapEx wise and what they're actually trying to do to grow the business, to make it bigger and try to actually expand what they're working on. Their CapEx hasn't gone up anything crazy. Their margin has expanded year over year, which is awesome to see. And it's 11% increase from last year to this year. So at least for the quarter. So I do love seeing that. And then the other thing that I wanted to point out is that they updated their guidance for 2022. And obviously, when companies do this, markets react differently. So in case you saw a huge drop or huge increase, this is something I wanted to point out. So I went back to their guidance for Q2 2022. One thing they pointed out for fiscal year 2022, and I'm just going to look at the full year 2022, is they're estimating that the revenue is going to be between 2.32 billion and 2.33 billion, and they have kind of updated that to be 2.318 billion to 2.32 billion. So they've really narrowed that range, and a lot of that has to do with the fact that the currencies have changed so much that they actually have to take this into consideration now. The other thing that they wanted to point out was the fact that they had free cash flow got updated as well. So they updated the lower range. So it used to be 760 million on the bottom end and 790 million on the top end. They've updated that bottom end to 770 million to 790 million. So we'll see where that lands for the year. But again, as I mentioned earlier, $1 billion is their goal. So to have them be pretty close at almost 800 million is awesome. And again, they're going to keep growing this and try to keep growing it. Um, Other than that, that's pretty much what I have for the results. Now, diving into kind of what they have said within the conference call, I took this transcript from Seeking Alpha, so if there's any weird transcription errors, I'm sorry. I'll try my best. How about that? So one thing that they had mentioned was that they had exited, he said, we had exited the quarter with 17.55 million paying users and added approximately 180,000 net new paying users in the third quarter. Average revenue per paying user, again, is $134 in Q3, up from nearly, again, $133. I don't know why a dollar is showing, but primarily driven by increased pricing on our Teams plan, partially offset by the foreign exchange headwinds and the adoption of our family plan, which, as a reminder, is comprised of 6 seats and therefore carries lower ARPU profile. With that, let's continue with the P&L. So again, gross margin was 83%, representing an increase of nearly 2 percentage points on a year-over-year basis. The improvement in gross margin was primarily driven by ongoing efficiencies in our data center infrastructure, as well as greater optimization around our customer support needs. So, when you see things like this, and again, I'm just kind of going through, I kind of pieced out their earnings call and kind of pick things that I wanted to take a look at. But these are kind of the key things that I'm looking at when I'm looking at this is you want margins to expand, you want ARPU to go up, you want revenues to go up and things like that. And, it may seem obvious, but when you're listening to an earnings call, you're listening for these key pieces. These are good signs. And obviously, the faster and the higher the growth, the better. But obviously, when you're coming into a company like this, it's not like a high growth tech stock company that's going to grow 100% year over year. That's not what I'm coming to and expecting. And again, at the, PE ratio and price to free cash flow ratio that it's at right now, it's kind of probably towards the fair value to upper fair value range. So, that's where I'm at with this company. But continuing on, so moving on to our cash and balance, we ended the quarter with cash and short-term investments of 1.5 billion. Cash flow from operations was 250 million, and third quarter in capex was 6 million. So that leaves us with a quarterly free cash flow of 245 million compared to 221 million in Q3 2021. In the third quarter, we added $18 million to our finance leases for data center equipment. So that's really important. It's something you want to see. You want them to make sure that they're actually expanding their infrastructure. They're not just, wasting money on nothing. The other thing, again, this is what I wanted to mention with the free cash flow, is that they're actually using this free cash flow to buy back shares. Now, this is kind of where the controversy for me at least is kind of, or not controversy, but just kind of where I feel torn is, they're buying back shares, which is great for the shareholders now, but they have that convertible senior notes on their balance sheet. So at the end of the day, if they keep those convertibles, they don't try buying back those convertibles, what's going to end up happening is you're going to get diluted anyway. So it's almost like you're just staving off the inevitable at some point. So but they said, let's turn to our share purchase activity. In Q3, we continued executing against a $1.2 billion authorization that was approved earlier this year by repurchasing 7.7 million shares, spending approximately $171 million. And as of the end of Q3, approximately $922 million remains under the current authorization. So, at about I think it was an 8 billion, market cap last time I checked. So that's like 10-12% of the market cap is currently authorized to be bought back. And I think that it's important that when you're looking at a company like this, you need to understand like they have free cash flow, they're generating free cash flow, and they're getting this cash in, but should they be buying back shares right now? I don't necessarily think so, but when it comes to returns and looking at what the best return is, if they find that, we could go and acquire a business right now, or we could wait and just, buy back shares in the meantime, that's I kind of think where they're at. And again, as long as the financial engineering is working because of the environment that we're in, it's fine. But they're not putting themselves at such a risk that if some sort of downturn happens, it's going to put them at a huge loss. But it's something you want to pay attention to because you want companies to be buying at the low end of their stock price, not at the top. And so if there's still some pain ahead and they, if they think their company is fairly valued and they're still buying the company, that's a little something that you want to pay attention to and something I figured I would mention. But again, they bought back some shares, which is awesome. And again, they're raising their full year 2022 guidance from 2.318 billion to 2.32 billion, up from the previous guidance range of 2.308 billion to 2.318 billion. And that's on the back of actually seeing, foreign exchange rates actually impact the business. So that's kind of an interesting point. But I just figured I would mention it. As related to the full year free cash flow, we are raising the midpoint of our 2022 free cash flow guidance. As a reminder, compared to when we introduced our free cash flow guidance at the beginning of the year, the significant strengthening of the dollar has resulted in more than $30 million in headwinds to our initial free cash flow guidance. So that's something that, again, you should be paying attention to, and something that foreign exchange is not just impacting this company, it's impacting a lot of companies. So, when it comes to all this, make sure you're paying attention to that kind of stuff. Now, moving on, we got a question from one of the analysts in the earnings call. It said, Love Sada from Brent Thill. Congrats on a solid trend here. Just wanted to ask, maybe first one for Drew. One of the comments you made in the prepared remarks was around churn rates for teams' plans being down despite the price increase. I guess you could unpack that a little bit, just be given the environment we're in today. Some of the other companies are facing higher churn rate within the small business side. So just unpack that customer base and what drove the strength here. And so just to quickly explain the question. So a lot of times you'll have people just kind of turn over within your customer base, and they've actually had a way better opportunity to keep people on their side. So Drew Houston said, sure. So I'd say a couple parts. So one is churn or customer retention has been improving overall in the core business, and that's a trend we've been seeing continue. I'd say on the price increase or the new plans, I'd say churn is ahead of our expectations. And so it's gone, or the packaging changes have gone better than we anticipated. And part of what's driving this, or part of what we believe is better than expected, is seeing the packaging and pricing changes as part of our flywheel, where first, we create new customer value, and so in that case, it wasn't just a price increase. We also introduced a lot of security features for teams that had been seen in response to customer demand. So really the most important thing in all of this, and I kind of just going on with that point of what Drew Houston mentioned, they had introduced a ton of security features, and they kind of showcased it on their website, but they introduced a ton of security features that a lot of people have been asking for on top of bringing in these pricing changes. And so it doesn't just seem like, oh, here's the same product, we're just gonna we're gonna increase the price 20% or however much it was on you, but you're not going to get anything new. They actually introduced capture. They They changed Dropbox or Hello Sign to Dropbox Sign, introduced capture to all the different tiers, and as well as that security features that everyone has been asking for. And that's kind of been the big thing across everything, and really creating more of a uniform Dropbox offering for everyone. And that's why I like the business, is you can see that the customers really like the business, and you also see that management understands what's most important to their customers. They seem very closely attached to them. And again, when it comes to businesses like this, there's always a risk that something's going to turn down, or that we may have a downturn in the economy or things like that. So never forget the downside risk. And obviously, I think that this was a better earnings call as far as the last few that I've seen from Dropbox. But, very exciting things to see this company grow just a tiny bit and actually start making progress towards their goals of $1 billion. I think they said by the end of 2024 is what they're shooting for $1 billion. So it'll be really exciting to see, and keep following this journey, and let me know what you guys think down in the comments below. I'm really looking forward to your comments. But if you have any suggestions or anything like that, or if you want to debate me on something that I've said today, let me know down in the comments below. I look forward to hearing from you. With that being said, have a great one. Happy investing. Have a great day.